Hey, this is Arvin Talley with Elixir Mortgage Lending. Today I wanted to define what a hard money loan is. A hard money loan is an asset-based loan, usually given by an individual or an institution. In our case, it will be institution. We do not work with individual investors. And they are a little bit higher risk loan, meaning that we will not require you to have any type of income verification. Therefore, the risk that a lender is taking because they are not verifying you with income, and a lot of times we can do lower credit scores, it will reflect in the rate. The rates are not going to be like a conventional loan. In this market, there'll be maybe some in the high eights, nines, tens, or so as far as rates go. They're generally shorter term loans. They're 1 or 2 year terms. In our case, a 1 year term has no prepayment penalty, but a 2 year term may have about 6 to 8 months of prepayment penalty. Let's see. I have some questions that was asked by someone, and I want to make sure I address all of that. As far as why hard money? Well, hard money is a good way to mitigate risk to your liquidity. So if you have cash to do the whole project yourself, buy the property, do the rehabbing until whether you sell it or you make it into something longer term, you're taking a risk with the bank or investor or lender's money as opposed to your own. The reason I don't personally, or I wouldn't personally use cash is this. If you miscalculate, whether it's timing the market or buying too high or running out of money for construction or rehab, and you have to go back and appraise that property while the property is not done, it is going to be much tougher to do financing on it, or you could get stuck, or terms could be very unattractive. But if you have the parameters set out of the gate and you hold on to your cash, whether the project gets done or you have the cash to get it to the finish line, you just have a little bit more of a net to catch you. That's my take on it, but others could have varying opinion on that a little bit. But personally, financing has benefits. As far as money goes, you will, since it's asset based and we don't have income verification, you're going to need, in most cases, 20% down payment. 20% is for most metropolitan areas in California, Florida. We do also maybe about another 9 or 10 states, but California and Florida is where we're most focused on. If you go into more rural areas, they do get more difficult to lend on, or if we do lend on them, they're going to have more down payment, probably maybe not as attractive of terms. So to stay into areas that have a population of over 50,000 in the city generally helps. When you go down too far, especially if there's less comps and things like that, it has other things that open up. If you go into a town that's just sales aren't happening as frequently, that's a high risk for a lender, as well as when we have to appraise the property, it hasn't been in money sales, that's going to be a little bit of a challenge. In the case, how much money does one need to get one of these loans done? Well, whatever the purchase price is, in most cases, you're going to need 20% down, some cases 25%. And you're going to need money for closing cost. Closing cost, that's escrow, title, the per diem daily interest, a year of insurance in advance, maybe perhaps taxes and insurance, some for escrow accounts. There's a number of different things. And there is also reserve requirements. Sometimes it might be a month to 3 months. Other times it might be 6 months. It does vary. We can do these type of fix and flip loans, hard money or bridge loans in California and Florida with 500 or higher credit scores. but the lower the credit score, the terms are not going to be as attractive. They're not going to quite line up maybe at 20%. They may require more money. They're going to probably have inferior terms. Ideal situation is to be 680 or higher FICO score. Over 700, you start getting really rewarded for it. I hope I covered everything to know about hard money, bridge loan, fix and flip loans for those of you who are thinking about investing or are investing, or for that matter, need money to take out of your property. You can also do cash out refinances once you're done with construction, especially once your rehab is done. The values, the after repair values, we can utilize those to take money out. If you have any questions, feel free to reach us here at Elixir Mortgage Lending. Thank you.